There's one belief Australians hold more firmly than almost any other. Not a religion, not a footy team, it's this. Property only ever goes up. Well, bricks and mortar, safe as houses, that's what they say, and you can't lose. Well, this year, quietly, without a crash and without a headline panic, that belief stopped being true. Prices are falling. The Reserve Bank just made a move that tells you they know it. And for the first time in a long time, the great Australian property machine is in genuinely shaky territory. So let's take a look at what's actually happening. Honestly, both sides, because this one affects almost everyone listening. Welcome to the new Rich Academy weekly briefing. On Troy Harris. Well, property's carrying today. It's the story of the week, then quick hits on gold and Bitcoin as well. 10 minutes, let's get stuck into it. Let's start with what the Reserve Bank actually did last week. Well, they held the cash rate at 4.35%. That's the second hold in a row. And to understand why that matters, you have to remember how we actually got here. At the start of this year, the RBA hiked 3 times in quick succession, February, March, and May, and wiped out every single rate cut that they'd given us in 2025. So money got expensive again, and it got expensive very, very fast. Now, they've paused 2 meetings running, watching to see if the damage is done. They won't rule out one more hike. Inflation's still above target, sitting at 3.8%. But all 4 big banks now reckon the hikes are finished for the year. The fight has quietly shifted from high-low to how high is this actually going to go, right? Because where we are right now is how long until they cut it again. And most economists don't see a cut until the middle of next year. Now, here's the tell. When a central bank stops hiking and starts talking about how long to hold, it's because the economy, and housing especially, is already doing the cooling for them. And the numbers show exactly that. National home values fell 0.7% in July alone. It doesn't sound like much until you realize it's the first sustained quarterly decline since late 2022, and it's accelerating at the top end. Premium properties, the expensive stuff, are down over 3% in just 3 months, actually. And auction clearance rates tell the same story in real time. They've been stuck around the low 50s, crawling just above 55%. Compare that to the same week last year when clearances were up around 73, 74, sometimes even above 75%. That's the difference between a room full of competing bidders and a room where half the properties just don't even sell at all. Home sales across the capitals are down about 16% on a year ago, and listings have surged to their highest level in over a year. Quite simply, more sellers and fewer buyers. You don't need an economics degree to know what that does to price, of course. And the quiet killer underneath all of it is borrowing power. Every time rates go up, the bank will lend you less. Those 3 hikes this year have stripped roughly 7 to 8% out of what people can actually borrow. So in real money, a single person on an average wage can borrow around $36,000 less than they could in January. A couple around $72,000 less. That money didn't go anywhere, right? It just vanished from what buyers can bid. And when everyone can bid less, quite simply, prices fall, and that is the whole mechanism. Now, and this is where I have to be straight with you because the headlines love the word crash. And this is not a crash, in my opinion. This is not one market, it's 2. Sydney and Melbourne are leading the falls. Some forecasters have Sydney dropping around 14% from its peak at the start of the year. Melbourne close behind. That's pretty serious, but at the very same time, Brisbane, Adelaide, and Perth are still growing just more slowly, and Darwin's actually the strongest market in the country right now. So the whole thing around Australian property is falling is true, but it's also misleading in the same breath. It depends enormously on the postcode. And I want to give you the honest range, not cherry pick the scary number. The gloomiest forecasters are talking about national falls approaching 10%, but the big banks, Commonwealth, Westpac, and so on, they're actually landing on roughly flat for the year. So KPMG splits the difference, down about 1% this year, then bouncing back over 3% next year when the serious forecasters are spread from flat to down 10. Now that tells you the truth. Nobody actually knows what's going on, and anyone selling you certainty in either direction in my opinion, is quite simply just selling you something. One more piece that matters, the tax changes in this year's federal budget. That was a big one because the ones touching negative gearing and capital gains really knocked the wind out of investors specifically. And I spoke to several investors, and it was a really, really big kind of news story at the time. Now, that's a big part of why demand softened so fast. But here's the thing the doom stories leave out. The deep foundations under Australian property, they haven't actually moved. We still have a massive housing shortage, population is still growing, rental vacancies are still near record lows, and rents are actually still climbing. So the thing that makes prices fall, expensive money, that is just a temporary thing. This is absolutely not a permanent thing. So the things that push them up long term are all still there. That's the tension the whole market is sitting inside right now. Right, quick hits. Let's hit on some gold first. And if you've been with me for a few weeks, you'll enjoy this. A fortnight ago, gold was soft because the Middle East had gone quiet. Well, the US and Iran, they're back at each other's throats again. The war's escalating again. And right on cue, gold's ripped back up to 4,400 US an ounce. It does this every single time fear returns. This is nothing new. It's still about 20% below its record from January, but it's the strongest it's looked in a couple of months. Watch this week, though, because there are two big US inflation reports landing Wednesday and Thursday. And if inflation runs hot, the US central bank stays tough on rates, and that usually leans into gold. So gold's riding war fear up and inflation fear down at the same time. It'll be interesting to see how this week pans out. Let's now touch on Bitcoin quickly, because after the drama of the last few weeks, and as I shared last week with the whole cold wallet hack and the whole custody argument, it's gone pretty quiet, really. Sitting around 64,000 US dollars in that kind of ballpark range. It's barely moving, which for Bitcoin is practically a coma as it is right now. It's still roughly 30% below its record from last October, and it's down more than $50,000 from where it was a year ago. Big picture, it's still grinding through a long, cold stretch. And in my opinion, as always, as I've always shared, and also in my book, Crypto New Rich, I share this, we are in that spot where we're just chugging along and going sideways. And it's waiting on the exact same thing as gold, those US inflation numbers this week. So for the short-term movers or the traders out there, make sure you keep an eye on those US inflation numbers this week, because more and more Bitcoin trades like a high-strung tech stock when it comes to trading. But if you're an investor, simply just hold and accumulate more. It moves when interest rate expectations move for you traders, so don't be surprised if a quiet week turns up the heat a little bit more as we head to the back end of it. So here's your signal for the week, and it's really about property, because that's what I wanted to lean in today, because that's where the lesson bites the hardest. And I touched on this earlier when I said, when people say property only goes up, it was never a fact. It was a story that happened to be true for a very long time. And a story that's true for long enough starts to feel like a law, starts to feel like it never changes, right? But it's the same trap I keep coming back to on this podcast, building your whole plan on a single belief that's never allowed to fail. The person who bought at the very top this year stretched to their absolute limit, banking on prices only ever rising. That person is now the forced seller, and the forced seller loses in every asset every single time. Now flip it, the person who kept a buffer, who didn't borrow to the ceiling, who wrote down months ago that the price they'd actually want to buy at, and they waited for that, well, for that person, this exact moment is the best time to buy. Negotiating environment of this entire cycle, this is the best time. Expensive money, but cheapening assets, shrinking buyer competition, and no auction bidding war really whatsoever. Still the same market, but two completely different outcomes. The difference isn't luck, and it isn't the timing of the bottom. It's the one, it's that one in particular of them prepared, and the other one is a predicted one. So the new rich prepare. This is the kind of message I've been trying to say each week, so that whichever way the market breaks, they're never the one that's forced to make an act. They can sit back and see how the market reacts. Your one action this week, and it's different depending on where you stand. If you already own, pull up your loan and ask one brutal question. If the RBA does squeeze in one more hike, can I still comfortably pay this? Know your buffer before you need it, not after. And if you're hoping to buy, this pause is your window to get your finance sorted and to write down, actually physically write down the suburb and the number that you would move on, right? So what suburb it is you want to go to, what number does it have to be at for you to move on that price? Because when this market turns, and history says it will, as it always does, the people who win are the ones who decided before the crowd came back. Not financial advice. I'm just saying to do your homework. Comment of the week. My dad said property never goes down, so who's right, mate? Your dad's mostly been right for 30 years and even longer, which is exactly why this catches so many people out. Mostly for a long time is not the same as always. I love that comment though. So subscribe so next week's feed lands into your feed as well. I'm Troy Harris. As I say, prepare, don't predict, and I'll see you next week.